Hello everyone. So now let us continue with our discussion. In the previous lecture, we have completed till proxy statements. Okay. Now give the next heading, that is your financial statement notes. Financial statement notes. Now they are also known as footnotes. Okay. I don't know whether you have checked the financial statements or not. Okay. But if you look at it carefully, at the end, you will see this footnotes. We call them as financial statement notes. Clear? Imagine you are buying a second hand iPhone and online. Okay. So you will see the main photo and the price of that particular product. But smart buyers, they don't just look at the main photo. What they will do, they will scroll down and read the complete description, whether it is original or not. Is there any scratches, battery health, okay, is the charger included and everything. Now this description is like the footnotes in the financial statements. So now let us consider what it is from the income statement, balance sheet, or cash flows perspective. Clear? Basically, write down these notes explain how the numbers are calculated. These notes explain how the numbers are calculated, comma, what assumptions were made, comma, and any hidden facts you must know, and any hidden facts you must know before trusting the numbers, before trusting the numbers. Clear? Basically, a example, if I'll give you one example, company shows that there is 100 crores in asset on the balance sheet, but when you read the footnotes, you actually found out that 40 crores of that is just a goodwill which you have in your asset because you have acquired the another company. So now you can judge the quality of the assets in a more better way, because this 40 crores you cannot get anything out of it. Main asset of the company is of 60 crores. Clear? So basically this will help you to understand each and every figure in detail. Clear? Now, with respect to this footnotes, there are 4 points. Point number A, basis of presentation. Basis of presentation. Basis of presentation. This means how the company has prepared the financial statements. This means, write down, this means how the company has prepared the financial statements. See, basically there are multiple rules, okay, by which we can prepare the financial statement, like US GAAP or IFRS. Clear? So we need to specify that which particular rule we have actually followed. Clear? So this footnote will help us to understand, okay, this particular company have followed the US GAAP. Clear? Secondly, which period or which year in this particular statements are covered. Clear? Whether all the subsidiaries are included or not, and if it included, what are those subsidiaries company. Like Reliance Industry, they own the Geo and AGO. Okay. Now the notes will tell us if the financial reports include the Geo and AGO or not, or is it just the Reliance Industry, that is the parent company. Clear? So this will give you the complete understanding of the financial statement with minute detail. Clear? Second we have is accounting methods and assumptions. Accounting methods and assumptions. Accounting methods and assumptions. See, basically, when you will study the accounts in more detail, you will identify that there are multiple ways of calculating the same thing. Like in when it comes to the inventories, okay, there are two methods which are generally used. One is the FIFO, another one is the LIFO. So which method you have actually used to calculate the inventory? Whether you have used the FIFO, first in first out, or have you used the LIFO, that is last in first out? Clear? Or what is the useful life of the machinery they have assumed, whether it is 5 years, 10 years? So all the rules, methods, assumptions, everything will be included in your footnotes. Clear? Now these assumptions will impact your profits and the asset value. So when you know all these methods beforehand, when you know all these assumptions, you will be in a better position to take the decision and to calculate the true value, whether it is an assets or whether it is a inventory. Clear? Third, which is very important, other important information. Other important information which are not visible in your financial statements, but they are very important. Like, is there any lawsuit going against the company? Then it is not visible in your accounts, whether it is a profit and loss or whether it is your balance sheet. So you need to specify in your notes whether there is any lawsuit, means a legal case is going on against the company, any contingencies, any contingencies. Clear? That means, is there any possibility of future losses? Clear? Then employee pension obligation. Employee pension obligation means in future when your employee will retire, okay, you need to pay them the pension. Clear? So the money to be paid to the employer after retirement, so whether you have accumulated that amount or not. Clear? Any major customers, any major customers. Clear? Or any related party transactions, any related party transactions, because suppose you have made a sales of say 100 crores, okay, 100 crores. Now out of that 100 crores, say 80 crores is to your related party and 20 crores is to a single customer. So with this I'll get a brief understanding that, okay, if there is no related transaction, then we do not have a good sales to show. And what if this particular single customer will vanish? He will not purchase the product from you next year. What will happen then? Clear? So it needs to be specified. Clear? Example, I tell you, if Zomato is being sued by some restaurant chain, so that will definitely impact their profit later. Clear? So you should know that in the footnotes that this can happen in the near future. Clear? Fourth point, that is post balance sheet events. Post balance sheet events. Write down. This means that happened after the balance sheet date. This means events that happened after the balance sheet date but before the report is published. Means, try to understand that there is a gap between, suppose my financial year ends on 31st March. Clear? So I have included all the financial transaction till this date in the financial statement accurately and everything, but I have published the report say on 1st of July. Clear? Now in between April, May and June, we have 90 days and something big has happened, something material has happened. Suppose a factory got burned out. Clear? So it's important that I need to mention it in the report that something big has happened, like my big factory got burned out. Okay. Now it will definitely impact your future financial statements because there is a lack of profitability, you will lose your assets, so many things are going on. Clear? Now the point is that, is there anyone who is going to verify this footnotes? Means the balance sheet, PL, cash flows, they all are checked or audited by the auditors. Clear? Now auditors are also going to check the footnotes to ensure that they are true and fair. So you can trust that footnotes are also trustworthy and reliable. Clear? So this is your first segment, which is about the financial statement notes. Clear? Now coming to the second point. Now after doing this footnotes, second thing which is very important is the segment reporting. Give the heading segment reporting. Basically breaking down the business. Okay, see, every big companies today has many businesses or work in many locations. Think of like a Tata group. Okay, they are into everything: cars, information technology, TCS, Tata Tea, watches, Titan, hotel, Taj hotels. So would you judge all of the Tata business the same way? Definitely not. So that's why companies break down their financials into statements. Okay, so either by business line or by geography, so that you can analyze that, okay, the Tatas are making the profits of say 100 crores, but these 100 crores are coming from which domain or from which country? Suppose 60 crores is coming from Tata Motors, 5 CR is coming from Titan, or say 8 CR is coming from say IT, Infosys, sorry, TCS, Tata Tea, Taj Hotels, like this, and you combine it to 100 crores. So you will get a good understanding that, okay, Tata Motors is contributing a lot to the organization. Or might be you want to do it from say from US, how much business they are doing, from India how much business they are doing, clear, from Canada how much business they are doing. So you can break down their financial statement either by the business lines or by the location, clear. Now we know that this is very useful, and you will be able to see that which part of the business is doing well or which part is doing very poorly, clear. Now suppose TCS profit margin is 25%, but Tata Motors profit margin is 3%. So as an investors, you might be interested in a business which is giving you high margin, clear. So now we are going to study about the business segment and geographic segment in detail. Okay. Now, this segment will include the informations like revenue and the profit of each business, assets which are used in each business, growth rate of each particular department's, return on assets from generated from each of the business unit. Okay, imagine that you are analyzing Amazon. Okay, their e-commerce segment might have a huge revenue but low profit margin, but their AWS, that is Amazon Web Service Cloud business, might have lower revenue but a very high profit margins. So you want to invest in Amazon, and you will be more confident that if AWS will grow faster, then the value of the company will start growing more than you imagine, clear. Now give the first heading business segment. Business segment. So now, just now what I have discussed with you, that if I'll take the example of Tata Motors, they will have multiple business segments. Okay, it will includes the Tata Motors, TCS, Tata Steel, Taj Hotel, Titan, and so more. Clear? Now each of these business are very different in terms of what they do and the kind of customers they serve. Clear? As well as the risk they face. So they are different on many parameters. So we treat each one as a separate segment of the Tatas. Clear? So business segment is like a mini company within a bigger company. So Tata is a bigger company, and inside these there are these smaller segments. Clear? Now when we do actually call something as a segment, basically a business lines become a reportable segment only if it is big enough. Means, try to think like that: Tata have TCS. Now suppose TCS are also doing multiple business, say website development, software development, okay, or you can say they might be into the income tax filing system setup, they are into the passport service as well. So now I cannot consider each one of them as a segment, then it will create a lots of problem. If that particular segment is contributing 10% or more towards the total revenue of the company, 10% or more towards the total value, or you can say towards the total revenue of the company, means suppose 100 cr is the total sales of the Tata. Clear? Now they have segments A, B, C, D and E. Suppose they are doing 15 CR business, 25 CR business, 5 CR business, 30 CR business and say 8 CR business. So now I will consider only these three as a segment. I will not consider them as a segment because they are a very small part. Clear? So 10%, 10% or more either of revenue or profits or total assets clear, then it must be reported separately in the financial statement. Clear? So suppose if the Tata Steel makes up the 15% of the total revenue, then it will become a segment and then we need to report it separately in our financial statements. Clear? Now the purpose why we do so, basically it gives us a clear picture of what's happening inside a company. Clear? Let's say company is earning a good profit overall, but one segment is making a big loss. Now you would never know about that particular thing that a segment is making loss until unless you will create them individually. Okay, so in order to identify that, you need to create these things individually. Clear? And what you should disclose in each of these segments, each and everything related to your income statement, which includes your revenue. Clear? Both external as well as internal. When I say external, means when you are selling something to someone outside your company. Internal revenue means you're selling between among your segment, means suppose Tata Motors required some IT service to set up their say features, AI features in the car. So they will go to the TCS. So the revenue of the TCS which is coming from the Tata Motors, that must be specified separately. Now Tata Steel selling the steel to the Tata Motors to manufacture the car. So the sales of the Tata Steel to Tata Motors must be mentioned separately, that this is sold within the organization. Profit and loss of that particular segments, asset and liabilities of the particular segments we need to show. Interest revenue or interest expense, that also need to be shown separately. If they have purchased any property, plant, equipments, any intangible assets, that also needs to be shown separately in each of the segments. Depreciation, amortization also, if there is any non-cash expenses like bad debts, okay, or share based payments. Income tax expense for that particular segment. If there is any profit from the joint venture or association, suppose a segment of it, you have done a joint venture with some company in Europe, so that profit also needs to be shown separately. Clear? Now there is one more rule, that is the 75% rule. Write down the 75% rule. Now mention that particular 75% rule. All reported segments together, must make up, write down, all reported segments together must make up at least 75% of the company revenue. Make up at least 75% of the company's revenue. So there are multiple segments. Clear? Now there are few which are very small. Okay, you can ignore them, but at least cover up those big so that the combined total revenue is at least 75% of the total revenue of the company. Clear? So these all are covered under your business segment. Now we have geographic segment. Another one is geographic geographic segment. Geographic segments. Clear? Now, sometimes businesses are separated by region instead of business type. Means a McDonald's. Okay, they are selling the same burger. Now, product and service remains the same, but they operates in North America, Europe, Asia. Clear? The product remains the same, burgers and fries. The business environment is different because the customers, rules, risk, policies of that particular country, so they all keeps on changing. Clear? So McDonald will also show the data by the geographic segment if those regions makes up 10% of more to the revenue, profits or assets. Means McDonald's is selling in more than 100 cities, but I will consider only those cities which are bringing 10% or more. That means they are material to the decision, because if somewhere they are getting only say 0.02% sales of the total sales, it's not material to show it as a segment. Clear? Let us take an example of a very famous company, that is Boeing. Okay, they are the aircraft manufacturer, and in one of its annual report, okay, in one of their annual report, Boeing said that we operate in five principal segments. Number one, commercial airplanes, Boeing military aircrafts, network and space systems, global services and support, and Boeing Capital, that is their financing arms. Now each of these have their different customers, they have different risk, they have different returns. So it will help the investors to understand which part of the Boeing is strong and which is actually struggling. Clear? So segment is like a different chapter in a company's story. Reporting segments help us to read the story very clearly, not just the summary. Clear? So it's very important for you as an analyst to analyze the company's report very carefully with respect to the segment, with respect to the geographic location. Now coming to the third one, that is management commentary. Management commentary. So till now they have disclosed you all about their business segment, geographical segment, financial statement notes, what's happening and everything. But now they will also comment about the future. Okay, it's like, write down, it's like the company's own story. The company's own story. So basically they will tell their own story, that today we are going to explore this very important part of this company's annual report, that is the management commentary, and this is also known as the management report, operating and financial review, and some even call this as MD and A. MD and A. M stands for management, D stands for discussion, and A stands for analysis. Clear? Basically this is a section where the company itself speaks to you directly. So instead of just reading the dry numbers, you get to read the company own story, basically their struggles, their achievements, their future plans, risk, everything they are going to discuss in this management commentary. Even they will tell you the growth for the next year, how much the growth they are expecting. Clear? If they are going to bring up the new products, new segments, everything needs to be discussed in this management commentary. Clear? It's like you have seen the mark sheet of a student, it will show you the marks of math, science, English, etc. But now imagine the class teacher writes a note below the mark sheet saying that Rahul has improved in maths this term, but he was weak earlier and he took extra help to overcome this particular issue. So however, his attention in the class is still bit low and he is planning to join a coaching classes next month. So this will give you a good idea about, first of all, he improved. Clear? How he improved? Some extra help, but still he is facing some issue in the class, that he is not attentive, but his future plan is to join the coaching next month. So this is a teacher note, is exactly the same with the management commentary. Okay, basically an explanation behind the numbers. Clear? Now write down, what does management commentary usually cover? What does management commentary, management commentary usually cover. What does management commentary usually cover? See, according to the IFRS, that is your International Financial Reporting Standards, a good management company, they talks about number one, the nature of the business, nature of the business, management's objective, management's objective, management's objective, past performance, past performance, past performance, then key performance measures, key performance measure, key performance measures, and the fifth one is key relationships, resources, and risk. Key relationships, resources, and risks. Now, when I say the nature of the business, okay, so they will tell us about what does the company actually do and who are their customers. Clear? When it comes to the second, management's objective means what is the goal of the company and what they are trying to achieve. They will tell you in the objective. Second, past performance. How did the company perform in the last year? How did the companies perform in the last year? So now you can compare how they have performed in the last year with this year reported. Clear? Now key performance measure. So how they're actually measuring their success, whether it is like revenue growth, profit margin growth, decrease in the liability, decrease in the interest cost. So new products launch and they are successful. So in what basis they are measuring their success? Key performance measures. Clear? And point number 5, who are their biggest customers or suppliers? Very important when it comes to the relationship. What important resources do they have, like strong branding, skilled employees? So what they do have, on what basis they are expecting the growth in the future, and what risk they are worried about? There will be the risk in the business, might be a new competitor, might be the government policies. So all these things needs to be clearly specified by the management in their report. Clear? So basically, if I'll give you one example, in the Reliance MD and A, okay, you might find them talking about the growth in the Geo subscribers, expansion in their retail stores, risk from the global oil pricing. So all these are specified in detail by them. Clear? Now, for the US company, there is some extra requirements by the SEC, by the SEC. Clear? That is their exchange board, Securities and Exchange Commission, and they have made it mandatory that these things needs to be included. Okay, so there are in total 7 things. Number 1 is trends and uncertainties. Write down trends and uncertainties. Basically over here the companies talks about the ongoing trends and possible future risk. It's like if an IT company notices that many clients are cutting their budget, okay, they should mention this trend even if it does not hurts your profit. Clear? Second, liquidity and capital resources. Liquidity means the company will be able to pay their short-term bills like the electricity bill, rent, employee salary, server cost, and so on. Clear? And capital resource means how they plan to finance their future operations. Means is the company getting enough cash or they are borrowing too much? Clear? Did they raise money by issuing the new shares? All these things needs to be discussed clearly even for the future as well. What's their future plan with respect to the cash management? Clear? Third one is results of operations. So basically company over here explain that why profits have increased or decreased. If profit decreased, why? Okay, might be because of the higher raw material cost or might be because of the competitor, they have launched a better product. Clear? Fourth one is the effect of inflation and the changing prices. See, inflation generally you will see that earlier in last year you have sold 100 units, this year you have sold 80 units. Clear? but the price over here was say 70 and over here say the price was 120. Clear? So over here you made a sales of 7,000. Clear? Now over here it will seems like that you made a sales of 9,600, so your revenue have actually grown, but this is all because of the inflation, the price increase, but in reality the quantity which you will be able to sell that have actually reduced. Clear? So if Maruti Suzuki, if they are buying a steel to increase their production, and what if the steel price will increase, then either they have two options, either increase the price of the car or get a hit on their profit margin. Clear? Off balance sheet and contractual obligation. See, sometimes company have commitments or risk that are not shown directly into their balance sheet, but that must be explained in MD&A. Okay, suppose if a company has signed a contract to buy goods worth rupees 200 crore next year. Clear? But it is not recorded as a liability today. This is a off balance sheet obligation because they will buy it next year, so it will come in the next year balance sheet. But as per the US law, you have to specify today in your books of accounts. Clear? And coming to the sixth point, accounting policies that require judgment. See, sometimes what happens, the accounting decision are not black and white. Okay, management use their own judgment. Clear? To understand that which method should they follow. Sometimes it happens that you are using the LIFO method, sometimes you are using the FIFO, but you know that if you will use LIFO, your profit will increase this year, so you might be using this. Clear? So you need to explain which method you have used and why. Clear? Or I'll give you one example, how much value to assign to the bad debt or how many years to spread the cost of the patent. So this is basically an assumption. Clear? Because suppose you want to increase your profitability, so this year you will put less amount in the bad debt. If bad debt is less, your profit is high. Clear? So company must disclose if there is any such judgment and also specify the reason. And the last one is the forward looking plans. It's like future expenses. Clear? They might be operating the new plants or new infrastructure, new machinery, new technology, new hirings. Clear? Or future divestitures. Basically, if you want to sell any of your business unit, so that also you mention that this is your plan with respect to the next year. Clear? Now there is one more important point, that some part of the MD and A are verified by the external auditors. Okay, but some part are not even verified, not audited by the external auditors. So being an analyst or an investor, you need to read it carefully and remember that something may be more optimistic or something may be biased. So you have to use your own judgment to understand that what is good for you and what is just to showcase the good image but not for the reality. Okay, so I'll keep this much in this lecture and we'll continue ahead in the next lecture. Okay, thank you.